Directionally, the markets, as we all know, have been giving a lot of pain. For mid and small caps have declined by almost double than what Nifty 50 has. Would at least result in a place where foreign investors don't continue losing money just because of currency. Now, while the economy surprisingly did not slow down across all these quarters in the past, US markets have been one of the best performing markets globally. Now, what you need to effectively do to make a good decision is, now with the budget in, you're seeing fiscal growth or stimulus come in from two angles. Makes a very large impact in terms of the quantum of money that is flowing in or out of a country like India. Hello and welcome to Rupeeting. My name is Sagar Lele and I'm the founder of Rupeeting. Today, like last week, we're again going to talk about the markets and we're going to decode a little bit of the market situation for you. Directionally, the markets, as we all know, have been giving a lot of pain. They have been down over the last 6 months pretty steadily, wiping out all the gains from the last year. Falling about 10 to 12%, we are a little bit positive when it comes to one-year returns, which is pretty dismal given how we are accustomed to such stellar returns over the last 3-4 years before this. If you're, as an investor, invested in mid and small caps, your portfolios would have been suffering even more. For mid and small caps have declined by almost double than what Nifty 50 has. So everyone's waiting for that large respite in the markets, which we saw a little bit of last week. But is that sustainable? That's what we're going to find out by taking over just one topic, one concern area, which has been FII outflows. Now, there is not a very direct correlation of outflows and market downfalls. FII outflows are just one of the factors. Liquidity is just one of the factors that affects the markets, but it has been a rather important one given how aggressively FIIs have been selling out of the Indian markets over the last few months. And for that very reason, we're here to talk about whether this will stabilize from here or not. Well, last week, I took a bold call on my Twitter and said that FII outflows, according to me, are going to stabilize at this point in time. We may be somewhere near the bottom when it comes to FIIs pulling money out of India. And today in this video, I shall explain why I think that FIIs might just stop selling. Whether they'll convert into buyers or not, we don't know, but certainly the gravity of FII selling should come down in our opinion. So our argument around why FIIs could stop selling in India revolves around 5 key points. Please remember that FIIs, when they invest into the global economy, they have choices amongst many countries, and the flow of money depends on economic conditions that are prevalent in any country relative to each other. So we can't really look at any country in isolation and determine whether FIIs are doing a good job or not. Of course, FIIs have a more bird's eye view in terms of what's happening globally. And for them, what they take into consideration, like any other investor, is risk reward. So what is the amount of risk they're taking in a particular country? And what is the amount of reward they're getting in return for it? To determine it very simply for you, there are developed economies and emerging economies. Developed economies have relatively lower risk. Emerging economies have relatively higher risk. Developed economies have relatively lower growth rates, and developing economies or emerging economies have higher growth rates. Now, what you need to effectively do to make a good decision is divide the growth rate by the amount of risk and figure out how much growth you're getting per unit of risk. If that is more for a particular economy over another economy, the decision is pretty simple for the FII. They will move higher allocation towards that economy, right? So pretty logical. And to explain this further, what we've done is we've analyzed the US economy, the Indian economy, what's happening as an interplay between the two, and hence why we think the FII outflow would have probably bottomed out at this point in time. So we'll start with what's happening in the US economy and then slowly flow over to India over the course of this video. The US economy has been extremely resilient post-COVID. Growth rates have been very strong, unemployment at its all-time low, new hiring very high. Results for all companies have been extremely good. The only culprit in this entire equation has been inflation. And the Fed, like any other central bank, to tackle high inflation, had increased rates by its highest quantum at its fastest ever pace, bringing down inflation considerably. It's still a little above its comfort range, but it's still under control compared to what it was back in 2021 and 22. However, increasing rates has an impact. The inherent motive of increasing rates is to slow the economy down. Now, while the economy surprisingly did not slow down across all these quarters in the past, the impact of interest rates may now have started showing up in the economy. While the Fed has taken a reverse stance now to boost the economy, it has decreased rates by about 25 bits. It may not have that much headroom for rate cuts now, given the fact that the economy has started to falter. Now, whether it's because of past mistake or whether it's because of Trump tariffs or whether it's because of something else is for another day. However, what's important to note here is that earnings downgrades have started, not only for the broader indices but also for the Max 7, which have been the driving force for the US indices over the last couple of years. However, despite these earnings downgrades and despite the mounting pressure of Trump's tariffs, what's happening is that the US markets have been rising consistently. US markets have been one of the best performing markets globally, and that's where our call comes in. We think that with such risk prevailing and with the earnings itself slowing down, the valuations that the US is trading at might just stop to re-rate any further. So the US markets might just have peaked out at this point in time, and that may result in money stopping to flow into the US and out of the US into safer investments or places where the risk reward seems to be more appropriate. Another factor that makes a difference in terms of how foreign investors think is currency movement. Now imagine this. If an investor is sitting in the US, he decided last year to invest in India $100. The rate at that time was 82. Now that would have meant that he is able to buy 8,200 rupees of investments in India. Now imagine those 8,200 rupees grew by 5%, right? Perhaps it's grown by lesser, but let's for now assume it grew by 5%. That would mean that the investment of 8,200 actually increased to 8,610 rupees. However, now the US investor wants to take this money back. The rate now is 87. So when he takes the money back into the US at this rate, he would actually end up with $99. So despite a 5% appreciation in the Indian market, because of a currency depreciation, the investor would end up losing 1% by investing in the Indian market. In such a scenario, why would the investor invest in the Indian market when the US market itself, even in the treasury bonds, which are supposed to be debt instruments which are low yielding, would give a much higher return compared to the Indian markets? That, I hope, explains a little bit of why such an exodus of foreign money has happened from the Indian markets over the last 1 year. We've all been hearing about the depreciating rupee, and this is why it actually makes a difference. Now, our call at this point in time is that the rupee has depreciated so far because of dollar strength and because of a little bit of a hiccup in the Indian economy. Now, out of these two factors, we see that the Indian economy has sort of bottomed out. We see growth coming back. At the same time, we see that the dollar index can also potentially top out here. Now, the dollar index, why we're saying will top out is primary reason because of the erraticness of Trump. If you go back into 2017, the dollar index had topped out back then as well. We think a similar thing might be happening now as well. And that's sort of playing out over the last couple of months, but that might just get aggravated. The last reason why we think the currency might further stabilize is the fact that the Fed's actions are finally slowing down in terms of tightening of monetary policy in the US. That would result in somewhat of a respite to emerging market currencies, especially the rupee. So to put all of these things together, we think that the currency stabilization or the depreciating rupee stabilizing at these levels would at least result in a place where foreign investors don't continue losing money just because of currency, and hence that itself puts India into a better place when it comes to relative outperformance versus global peers. The other major reason why we think foreign investors might return is that the Indian economy itself is actually doing better than what it was earlier. We saw a minor blip in the Indian economy because the government spend on infrastructure and capex actually reduced during election year. Usually after the election year, when the first year of the government's appointment comes in, things are slow even then. It's only then that things stabilize after that and government spending actually picks up. Now with the budget in, you're seeing fiscal growth or stimulus come in from two angles, infra as well as consumer spending. Infra has obviously slowed down compared to what it was in terms of growth rates. However, it's still growing at a healthy double-digit growth. However, the other part that's come into play that was not before is boosting consumer spending. Now, mind you, infrastructure spending takes a while to materialize from spending into a burst into the economy. However, consumer spending is much faster. So the results from that are more immediate in nature. Now, both of these stimulus measures have resulted in some sort of a bottoming out in the previous quarter, and we're seeing an uptick which is very visible from the GDP numbers in this quarter as well. Most corporates have also indicated for a bottom to be somewhere close by and for recovery to start creeping in from the next quarter onwards. Given this, and the 10 to 12% correction makes us in a place where earning estimates have slightly stabilized, where valuations have corrected and are now probably at somewhat a comfortable level compared to what they were earlier. Both of these factors combined make India much better in terms of positioning compared to what it was a few months ago. So while all of this bodes extremely well for India, what we got to understand towards the end is also how sensitive India is to these movements. We've all seen that the exodus of foreign money has resulted in so much pressure on the Indian markets. We've all also been at the same time surprised at how much money is actually exiting India. But just to put this into context, I would like to bring to your notice something known as the MSCI World Index. Now, like the Nifty 50 is a benchmark for the Indian markets, at a global level, Morgan Stanley constructs an index which is the most widely used by fund managers, and it's called the MSCI World Index. Now, any fund manager investing at a global scale will try to beat the MSCI World Index. Now, how will they beat the MSCI World Index? Any fund manager does a couple of things. One is to include or exclude certain constituents so that they're able to beat the underlying index. Number two, which is a slightly safer call, is to go overweight or underweight a certain constituent. So, for example, a certain country is 10% of MSCI Global Index. Now, a fund manager would think that, hey, I don't think this country is going to do well. The markets are too frothy and I think valuations are too elevated. I think things will come down. So, instead of taking a 10% weight, they'll probably take a 5% weight. Now, if that index or that country goes down by 10%, the fund manager who's taken a lesser weightage in that country will obviously outperform the MSCI World Index. So, putting things into context, the US has a 65% weight in the MSCI Global Index. India, on the other hand, has a mere 2% weight. So when the US economy is doing amazingly well, the currency is very strong and emerging market currencies are weak. When the Indian economy is faltering a little bit while the US is doing extremely well, and where Indian valuations are extremely high when the US is relatively reasonable, one would expect a lot of money to flow from a country like India with 2% weight to a country like US with 65% weight. So even a little bit of a difference makes a very, very large impact in terms of the quantum of money that is flowing in or out of a country like India. So if things have to turn, you could expect that the quantum of outflow you saw, while that was shocking, you might just be surprised with the quantum of inflow as well. So with that, we'd like to end here by telling you guys that we've taken our call. I think our opinion is that there are several factors that align towards India's economic strength or the market strength relatively stabilizing compared to the rest of the world. So to sum it up, there are two key factors that we think are working in India's favor when it comes to FI outflows finally coming into control. One of them being that India's economic strength is improving and valuations have corrected, resulting in a much better place for the markets. And number two, the rupee depreciation seems to have stabilized with Trump doing his own thing and the RBI also actively intervening. So both of these factors could result in FIIs finally plugging the gap and saying that, hey, let's slow down on the selling and let the markets breathe a little. Just as a cautionary note, FI outflows or liquidity are just one of the factors that impact the markets. There are multiple other factors that come into play when determining the direction of the market, right from economic strength to corporate earnings to valuations to even domestic sentiment. So liquidity and FI outflows are just one factor. While they have been a major player in the past, the stoppage of this does not necessarily mean the markets turn around as well. We're just saying that one of the pressures for the markets is off, and that's a welcome sign as well. With that, thank you for watching. See you next time.